Okay, now we're getting into the engine room of IAS 1. These are the principles and assumptions that quietly support everything else. They're not flashy, but if you remove them, the whole IFRS structure starts to wobble. In this chapter, we'll look at the basic assumptions, key presentation principles, and the discipliner that keeps financial statements clear, fair, and reliable. Here's what we're focusing on in this part. First, we want to understand the assumptions that underlie all IFRS reporting. Then we'll go through the general features IAS 1 requires, like fair presentation, materiality, and consistency. And finally, we'll see how these rules help us avoid mistakes and keep the statements usable and trustworthy. This is where the real IFRS mindset starts to form. It starts with the absolute basics from IAS 1, paragraphs 25 to 27. There are two foundational assumptions for IFRS financial reporting. One, going concern. Two, accrual basis of accounting. These aren't optional. If either one doesn't hold, everything else from measurement to presentation changes. So let's break them down. Going concern means we assume the company will keep operating into the foreseeable future, at least for the next 12 months. If there's significant doubt or the company is planning liquidation or major restructuring, management must disclose it clearly and use different measurement bases, like liquidation value instead of fair value. It also has to be reassessed every reporting date. Why? Because this assumption directly affects how we value everything. So no going concern, no normal accounting. Now on to the second assumption, accrual accounting. This is the idea that we record income and expenses when they are earned or incurred, not when the cash moves. Example, if you sell a product in December but get paid in January, the revenue still belongs in December. This approach gives a much more accurate picture of some financial performance. Only one statement under IFRS uses actual cash flow, and that's the cash flow statement. Everything else runs on accruals. Now we're into general features. Fair presentation means the financial statements must show the company's position and performance faithfully and transparently. And here's the kicker. They must comply with all applicable IFRS. No cherry picking allowed. You can't say, I like IFRS 15, but IFRS 16 is inconvenient, so we'll skip it. Nope. Also, substance over form. If something acts like a liability, you treat it as a liability, even if the legal form says otherwise. Here's a rule that sounds simple but is often ignored in practice and consistency. IAS 1 says we should use the same format and classification each year, only change it if a new IFRS standard forces it, or the change improves clarity and usefulness for users. Otherwise, keep it the same, because consistency allows comparability. And comparability is what users need to spot trends and make decisions. Everything deserves its own line item. IAS 1 says we should highlight material items and aggregate immaterial ones. But what does material mean? An item is material if leaving it out or misclassifying it would influence user decisions. And materiality is contextual. A $1 million error is massive for a startup, but might be peanuts for a multinational. So don't treat all numbers equally. Focus attention where it matters. Let's talk about offsetting, or as IAS 1 says, don't do it, unless a standard explicitly allows it. You can't just subtract expenses from revenue and report a single net figure or assets from liabilities. Why? Because offsetting hides information. Users need to see the gross amounts to understand risk, scale, and structure. There are exceptions, for example, deferred tax assets and liabilities under IAS 12, but they are specific and limited. Transparency before simplicity. IAS1 says, always look back. You must present at least one prior period Ernstei for every line item and in all statements and most notes. Why? Because users need NC context. They need to compare this year to last year to understand performance and trends. And if you've restated anything from a prior year, you have to explain it clearly, usually following IAS 8. Comparative information isn't a bonus, it's a requirement. Let's wrap it up with a spoken summary of the key general features. We've covered, first, we always assume the company is a going concern, unless there's strong evidence otherwise. Second, we use accrual accounting. We record when things happen, not when money moves. Third, we ensure fair presentation. The statements must be complete, faithful, and fully IFRS compliant. Then we keep our presentation consistent over time. No changing formats just for fun. We apply materiality. Highlight what matters, group what doesn't. We avoid offsetting unless a standard says it's okay. And finally, we always include comparative information, because users need to see the full picture, not just 1 year in isolation. These are the building blocks of clean, trustworthy financial reporting under IAS 1.